Hi YouTube, good afternoon. This is Evan with Mainstay Property Group and Midwest Cash Offer, coming at you with a free money tip. If you guys like making 6.44% on your money, this would be an appropriate time to turn up your earpieces and pay attention. I had an investor in town with me today from LA, really sophisticated guy, really gets it, understands how to manage debt effectively to essentially position himself to acquire and repeat, acquire and repeat, acquire and repeat. My guy's killing me because he's accumulating a whole lot of debt, and he's buying these properties that are they're really well located, which is great. But we're talking 7.5%, 8% cap rates. He's getting good returns, building value, and repeating. But he looks at me today, and I think he's like, man, I'm losing sleep sometimes because I got like $800,000 in debt outstanding on investment property. Don't really matter if your properties are worth 1.2, 1.3 million, or even 1 million, or 900,000. Depends how risky you want to get. Anyway, this investor is like, man, I got a lot of debt. I'm trying to figure out the best way to diversify it without having to refile my properties and essentially add on another $3,000-4,000 per property just on the refi costs. Okay, so something I wanted to show you guys is it should be common sense. It should be more well known. It should be well respected in the real estate community, but for some reason, this term is almost never used, and it kills me. It's called a mortgage recast. R-E-C-A-S-T. Imagine a recast like a recast on a fishing pole. You throw it out, you reel it back in, you reposition yourself, you put on a new piece of bait, you throw it back out, recast. Okay. Mortgage recast can save you a great deal of effort, time, stress, and while it's hard to do because you have to accumulate capital to do it, it's one of the most powerful tools in real estate investing that I've come to find. So for those of you who are the pseudo-psychopath folks that just want to accumulate debt and property and have no care in the world about it, this isn't for you. Best of luck. But if you'd like to effectively manage your debt structure, pay down your debt, and essentially realize a 6.44% return in the interim, I'm going to explain to you how to do it. And by the way, if you're a loan originator watching this, now would be the appropriate time to push power and never watch the channel again. Loan originators and mortgage guys don't have anything to do with mortgage recast because they don't make any fucking money. So if you are a mortgage guy, tune out. Nothing to do with you. If you're an investor, pay attention. So this is a traditional amortization schedule for a $100,000 loan. I just put some really easy assumptions in here. $100,000, 5% interest. This is a traditional 30-30 loan, which 99% of our investors go for. You'll see here our payment at the door is $536, which is reflected right here in my personal column here. Okay. So what essentially I did is I went through here and I typed all this in. But I just went out here and I changed, my loan amount to 90s and all other assumptions the same, 483, and I just changed it right here too. So you can see all these numbers are the same, 429.46, 429.46, so on and so forth. So what I did is went here and just demonstrated the difference between this payment, or this amount, and this amount. If you are to put down an additional $10,000 in principal. So, for example, if this is your initial loan amount, and you say, hey, look, I just won the lottery, I won $10,000, I'm just going to pay $10,000 of that loan down so that my loan amount's now 90. My payment went from 536 to 483 instantly upon one recast. You go to your bank and say, I want to recast my mortgage, which 90% of decent human banks are going to let you do. My bank charges me $50, so I'm paying a $50 fee to recast this thing because I got to prep paperwork, whatever. It's worth it every time. You pay $50, or I guess your total outflow is $10,050. So you're putting $10,000 down in additional capital to pay down the loan, $50 fee to the bank, and all of a sudden your mortgage payment goes from $536 to $483.14. Right? So it's a difference of $53 annualized over 12 months. That's $644. So $644 over the $10,000 you spent, 6.44%. So what I told my friend here, who was in town this morning, I'm like, dude, have you ever considered doing a recast on these things? Like, no, I don't know about all that. I don't have the money to put down. I don't have the money to pay it down yet. I'm just trying to acquire more. It's like, man, if you got the money to acquire more property in cash, or even partially, if you're not borrowing 100% of these deals, you've got money. It's okay if you're going to buy a 6.7 or a 7.5% cap rate on this thing, 750 basis points on a cap, and you can return 644 on just paying down the note. What are we talking about? Why is this even a conversation? Think about the level of risk that he's taking on for an additional 100 basis points. So I'm passionate about this, and I think it's hilarious that, you know, it's sexy, and you're going to put it on Facebook, and you're going to do YouTube videos about buying my property, here's my apartment building, here's a rehab and construction. Look at what you can do if you just own a single-family property. If you own your own house, if you own a single-family house, look, 640 basis points for paying down your note, seemingly risk-free. Okay, so obviously interested to see if anyone's done this. I've done this for my personal primary residence 3 times now. Obviously, the higher the loan gets, the more the annual return will change. But very, very simply put, if you got a $100,000 loan, you put $10,000 down on it. By very quick math, you're making 6.4% on your money. So it's something to consider when someone brings a new deal. My biggest mantra, and something I say all the time, and I'm not a soothsayer. Acquire properties, buy properties from us, but for the same token, it's not sexy to do a flip. It's not sexy to own a rental. It's not sexy to have an apartment building. It's sexy to make a legitimate, true, honest financial decision for you and your family. And if you're going to buy something at 7% and take a risk and put your family's net worth on the line, or you can just pay down your house and make 6.4%. I don't know what we're talking about. So anyway, happy to answer more questions about this. My bank is Mutual Bank. Shout out to Mutual Bank. Work both with us commercially in our new headquarters, as well as all of our investors, cash out refinances as well. So hit up Chad Shelley at Mutual Bank with any questions, or give me a call if I can help out with recast questions or anything else that has to do with effectively managing your debt structure, so that you can either be a lean, mean, debt-free machine, or a wild man with plenty of capital to go out and tackle new projects. Over and out.